Hi, I'm Greg McDonald, Managing Director of Goodfish. We are injection moulders and tool makers based in Cannock in the West Midlands. We bought this business about 3 years ago, and we now have turnover of about £2.5 million with 30 employees. We have built this business through bolt-on acquisitions every year since we first acquired the business in September 2010. 6 weeks after having bought the business, with all the debt in place, our largest customer having left us, I was faced with a dilemma. Do I carry on with plan A, or do I set about plan B, which I hadn't even hatched yet? Unfortunately, plan B was the only way forward. The pressure of debt, repayments, monthly, day in, day out, I had to act quickly. I took out a whole load of overhead and restructured the business, letting go of the team that came over from the last place I ran, plus also all of the management of the existing business. What I did then was I increased prices on the low-priced work that was here and set about trying to restore the business's profitability. I made 3 bolt-on acquisitions, 1 every year, after we started Plan B in 2011. These acquisitions did not involve using bank debt. They were negotiated mostly on a deferred basis, with some purchase of fixed assets and stock, which I funded myself, but there was no additional bank lending involved, and we continued to fund the business through this turnaround period. The cumulative effect of these bolt-on acquisitions were that sales were rising and so were margins. At last, we were beginning to break into operating profit, if not net profit, with our debt burden. Since 2012, the trend for our sales has been slow growth, but the trend for our gross margins has been spectacular. We have gone from the low teens to the late 30s and early 40s by focusing on the operational issues of getting product made once, right first time, out the door on time, to customers who are satisfied. While all this was going on, of course, the funding arrangements had to be in place to support the turnaround. I used a small self-administered scheme. I used non-bank lending supported by regional growth funding, and the original vendor loan note continues to be paid down. The asset-based lending on the equipment continues to be paid down, and the invoice discounting supports our working capital as it always has. So what about the future? How are we going to fund that? Well, our strategy of building the business to 20 million of sales by 2020 includes a new line of product. As a service business with no product of our own at the moment, we are developing a new range of products for the cycling industry, and for the first time addressing consumers directly and the retail market with a product designed, invented here in Cannock. So how specifically will we fund those? Well, Kickstarter and Indiegogo are a great way of not only raising funding for a new product idea, but also in a 30 or 60-day period getting world recognition for one's product, or finding out that it's a dud before you spend too much money tooling up for it. So we're definitely going to try that. There's also further debt and equity funding from crowdfunding. But will we go that route? I'm not sure. We're not really ready for more debt until we can fund the development of our new product. However, acquisitions will continue to be funded with debt, and we have a large acquisition in sight at the moment that I'm currently out looking for funding to support, and that business would help us reach our target of 5 million sales for 2015 and set us well on the route for our target of 20 million sales by 2020.